Okay, good afternoon and welcome to this session of the London Financial Regulation Seminar, which is an intercollegiate and interdisciplinary group of experts, which is led by the Center for Commercial Law Studies and our Institute of Banking and Finance under my leadership. I'm Professor Rosa Lastra and also of Dr. Daniele D'Alvia. And today I'm very pleased to welcome my colleague, Dr. Reto Schiltknecht, who will discuss the rescue of Credit Suisse. The title of the seminar is A Sober Look at the Rescue of Credit Suisse. And we will be discussing how the deal was set up and whether or not the objectives have been achieved. And Dr. Reto holds the position of Senior Counsel at the Zurich-based consulting firm, and excuse my German, Geissbuhler Weber Partner, where he's responsible for the firm's risk management and regulatory practice. And he's an expert in crisis management and capital markets, including regulatory capital instruments, as well as licensing issues for banks and financial market participants. Prior to his current position, he had been with FINMA, which is the Swiss Financial Markets Supervisory Authority, as head of the Solvency and Capital Group with the Banks Supervisory Division, and since 2016 he was responsible for international policy affairs and policy issues, as well as deputy head of FINMA's Recovery and Resolution Division. And he was also a member of the Resolution Steering Committee and the Cross-Border Crisis Management Group of the Financial Stability Board. Dr. Reto and myself are expert members of a group that has been set up by UNIDROIT, the Organization for the Unification of Private Law, and we are looking at rules on cross-border banking solvency for those institutions that do not fall under the resolution. Sometimes there is a bifurcation in the legal regimes. Sometimes there is a single regime. It has been seen with the recent crisis, not so much of Credit Suisse, but of Silicon Valley Bank, that these issues are also very relevant because sometimes even a non-significant institution in some jurisdictions, like in the US, under the systemic risk exemption, can be declared significant. So, but back to the theme of today, as we all know, and I can see that we have in the chat, I'm very pleased to see current students, other experts that take part in our London Financial Regulation Seminar, as well as alumni, like my friend and former student, Gabriel Gomez-Giglio. So on the 19th of March, 2023, the Swiss banking group UBS agreed to merge with Credit Suisse for 3 billion Swiss francs in a deal that was backed by the Swiss government, the Swiss Central Bank, and FINMA. And the Swiss Central Bank supported the deal by providing 200 billion Swiss francs in liquidity, emergency liquidity assistance, while the Swiss government provided a guarantee to UBS to cover losses of up to 9 billion of Swiss francs. And additionally, 16 billion of 81 additional Tier 1 bonds were written down to zero. And an investigation has been opened up by the Swiss prosecutors, and there are a number of litigation that is going around. So Dr. My German Schiltknecht will provide us with thorough and precise analysis of both the facts as well as the possible legal and economic issues of this transaction, as well as concerns of creating large banks, too big to fail sometimes, via market consolidation. And we will be able also in this context to discuss further questions of systemic risk that are fundamental in the context of the fallout of this transaction, as well as the episode that we have lived in the US. So without further ado, the floor is all yours, and we will be projecting the slides that our events team very kindly will be passing on, and we have agreed that we will be taking questions along just to ensure that everyone is on Zoom. You're very welcome to switch on your camera if you wish, and particularly if you're going to ask any question during the presentation. I'll now mute myself for the quality of the recording, and I will give the floor to my colleague Reto. Thank you. Thank you for being with us today. I very much appreciate you joining.
Thanks a lot, Rosa, for this very friendly introduction. And thanks for this invitation, which gives me the possibility to speak about this Credit Suisse rescue operation. Maybe it's possible to project my presentation, and we can immediately go to the next page. Okay, so first of all, please call me by my first name. I'm suffering under my last name since all of my life because it's hardly not manageable by the Latin countries, by the Anglo-Saxon countries, by anyone except maybe the Germans and the Swiss. So call me please by my first name whenever you have a question. Let's get started now. Before we actually go into the transaction as such, I thought that it's maybe advantageous to develop some thoughts of principal nature. First of all, everybody talked about a bailout, except the Swiss finance minister. I have to confess, she always talked about a commercial solution, which is from my perspective wrong. So that, when you remember the 2008 financial crisis, there was a clear kind of aspiration to avoid bailouts, and bailouts meant at that time a really tremendous state support by the governments throughout the globe. Including the UK. You remember that the UK has taken over at that time several big banks. In the state has taken over then, from RBS to Lloyd's to others. And so everybody talked about bailout in that particular context. As far as I know, the term as such has not been defined. Whether kind of a tremendous support qualifies as a bailout, or even a less intrusive support. Nevertheless, the term is relatively fuzzy. However, and Rosa already pointed it out, the Swiss government was involved in that transaction by a number of measures that have been taken. So the answer to this question is, from my perspective, yes, because it does not really make a difference to what extent the state is engaging. At least also a relatively benign state support would qualify, from my perspective, as a bailout. So it's kind of the basis for the discussion. Taxpayers on the hook versus a fully private solution, which wasn't the case. So this is number one. So what the finance minister told us, fully commercial solution, was unfortunately not what happened. Then we heard about the transaction. I come to that in a minute, but the transaction in essence was a takeover of Credit Suisse by UBS, and the objective to calm down the markets, to stop the bank run, and to avoid a global financial crisis was reached. That's in a way to say yes to the question whether or not the mission was completed. The question is to what price. And interestingly enough, when I'm actually talk to people outside Switzerland, they all think, Switzerland did a great job, and the problem was solved, and so on and so forth. Domestically, things look totally different. So there is a lot of debating about whether or not the bailout was necessary, about alternatives, about the kind of general failure of the too big to fail legislation, and so on and so forth. So there is a huge debate domestically, and you know, that contrasts enormously with the perception outside Switzerland. So this is definitely for our country, and also for the future of the very large banks, which is actually, as it stands, only UBS, is an interesting aspect. I come to that then later on. Then it goes without saying, the too big to fail issue all of a sudden was again, or is again, in the spotlight of the international discussion. I'm actually emphasizing to that because you know, there was a clear statement also by the FSB about you know, these long-lasting projects too big to fail. They always talked about ending of too big to fail. There was a kind of a fatigue. They used the term fatigue of that topic throughout the globe, both in the regulated communities and foremostly also within the banks. So things have changed again, I think. So there is a lot of attention to this topic as we talk. So this incident with the Credit Suisse rescue operation led to that. Then a major question is, because the first big case in testing the too big to fail regime was not, the too big to fail regime was not applied. So it was in a way a solution by takeover, by a merger, and not the application of the toolbox that was foreseen for these kind of cases, be it restructuring or be it an orderly wind down. So this is just a matter of fact, and that leads obviously to the question, why was that not applied? And so there is all over the place, especially also in Switzerland, the frustration about rules and a concept that obviously I cannot say didn't work, because we just don't know that, because it was not applied, but there was a clear reluctance to apply it. And the question is, why was this? So you cannot say it didn't work, because you just don't know that. Okay, about the possible recipes, we will maybe discuss then later on. So maybe please go to the next page. I'm gonna make a quick stop. Is there any comment from the listeners to or the participants of the seminar to what I said on the first page?
Is there any, as I said, this is going to be, as I discussed with Reto, we will be stopping at throughout the presentation rather than just simply at the end if there is any quick comment or reaction. And if not, then we continue, Reto, and maybe. Yeah,
it doesn't seem to be the case. And how does it work with the questions? Are the participants asked to raise their hand, or how does this work normally?
It works both ways. So usually we do at the end, but it's very welcome as per your wish that we have the questions throughout, and they can either write it in the chat, and I will be monitoring the chat, or just raise their hand simply and or send me just simply a message to ask the
Very
question.
good. So
and, you know, what happened? We also have other.
Sorry, I just didn't want to interrupt you, Rosa. Go ahead.
No, we also have other experts in the room, friends of yours like Matthias Lehmann and Charles Goodhart, who are also attending. So there is, as I told you, students online and experts. So
very good. Welcome. So what happened on the 19th of March? I think Rosa, you know, has given in her introduction some elements of that. I just gonna go a little bit deeper here, just very briefly. We have on the left hand here the federal government, and we have on the right FINMA and the Swiss National Bank, the Swiss Central Bank. And in the middle, we have Credit Suisse and UBS. And as I said, the enormous bank run, and we have to be conscious about that again. So the bank run was enormous. Just to give a number, Credit Suisse Group had before the bank run started in October 2022, roughly 400 billion of deposits. 138 billion flew out until the end of the year. 138, an enormous amount. And in March, before the rescue operation started in March 2023, an additional 61 million of deposits flew out. So we talk about 200 billion deposits that have been outflowing versus roughly 400 billion in total of deposits. That means half of the deposits went away. So the situation before the 19th of March was really dramatic. What happened is on the 15th of March, as a consequence also of the US regional banking crisis, you remember the Silicon Valley Bank went bankrupt, the Signature Bank went bankrupt, and that led to the measures by the Treasury and the Fed, we all know. But in the wake of that, on the 15th of March, the Swiss National Bank and the FINMA decided to approve the request of Credit Suisse to launch the emerging liquidity assistance, and this was to the extent of 50 billion, as you see here on the screen. Unfortunately, the 50 billion did not really calm the situation, and the bank runs continued. So the 15th of March was a Wednesday, and on Thursday and on Wednesday, the run situation became even more severe. That led then to the crisis sequence over the weekend. In other words, it was inevitable to find a solution over that weekend of the 18th and 19th of March. Obviously, there were also this after the 15th, or maybe even before, I just don't know that exactly, started the negotiations with UBS for the merger. So the merger, is obviously one option out of four they had in that situation. Beside the merger, they could nationalize the bank, or they could try to introduce resolution by way, first of all, of a restructuring, or if that didn't work, by way of an orderly liquidation. So they decided to go for the merger. And the reason why they did that was that the confidence in the bank, the 200 billion of outflows were a clear sign, was finally destroyed. So that led to the assumption that also a restructuring would not solve the situation anymore, because the business model, or there was a clear reason to assume that the business model was destroyed. And an additional argument was against the nationalization, obviously, was that it's likely that the nationalization, that we know that from the past, would have led to a kind of a calm down of the markets. However, the questions remained open whether or not the bank in this configuration would be possible to continue successfully with that business model, and then not to underestimate the risks for the Swiss government. So to take over a bank by the state with a balance sheet which is bigger than the GDP is kind of very dangerous for a small country. So they decided to go for the merger. And as Rosa said, I don't want to replicate that. There was first of all an additional injection of liquidity in 2 tranches. And interesting is here, the first tranche of 100 billion Swiss francs was granted without collateral. So, and it was in favor of Credit Suisse and UBS. So it should also support the new company, or the merged banks. This was only possible, these kind of granting additional liquidity without the collateral, by way of emergency law. So the Swiss National Bank would not have been allowed to grant that facility by its own. So the Swiss government had to establish the legal basis by way of what we call emergency law. And the next tranche, so after the 100 billion, the additional 100 billion was collateralized, but not in a way we normally know, by securities, but by a state's guarantee. So this was within the limits of the law for the National Bank. But the problem was also here, Switzerland does or didn't know so far the public liquidity backstop framework. So one had to establish the framework also in a kind of an urgency by way of emergency law, which is kind of really a wrinkle. And the problem here was that there was a delay in introducing that public liquidity backstop framework over several years. So there was always, and I know that because I was in the midst of that battle, so to speak, there was always huge pressure from the UK, Bank of England, and the Fed that Switzerland should really hurry up in creating that framework. So that's about the liquidity. We heard about the guarantee. The guarantee is clearly also a kind of state's intervention. Just to explain that, the guarantee was given, or was supposedly given, I just did not see that the merger law or the merger contract so far, to back the rundown of a derivatives portfolio with almost kind of over-the-counter derivatives, currency swaps, interest rate swaps, and with sometimes a term of several years or several decades. So this is to back that rundown. Switzerland has given that guarantee. The first hit of 5 billion will be taken by UBS. Then Switzerland takes in case of a loss, takes a 9 billion loss, and then it's a little bit unclear what happens beyond the 14 billion, but there is an assumption at least that these loss should go beyond that limit, then most likely UBS will bear it. So that's about the transaction in more detail. Any questions to that? Any comments to that so far?
Any questions from the audience? If you want, as I said in the chat, either write it in the chat or to raise your hand in the Zoom conference.
I see someone in the chat, but I just don't know if you have any. Oh, that's just your comment. Yeah, okay. If there are no questions, I mean, I just don't go. I do not go into further detail of Swiss merger law and things of that nature. That's not of interest here. Okay, let's go to the next page then. So this is a page which should really bolster a little bit my statement that the bank was really at the end of a process that lasted roughly 10 years. So that's why I said the confidence of the customers and investors and so on and so forth was finally destroyed. So you see here, and I just don't want to go into the details. It already started, let's say, in 2013. I was heavily involved at that time in that with the US tax dispute. Credit Suisse at that time was fined by 2.6 billion for violations in the context of the US tax regime. And then there was over a decade a kind of turbulences in personnel matters. There were, as from 2015 on, there were 4 CEOs, chairmen that could not really solve the problem. And then these kind of famous trigger events in 2021 or in 2021, right? So there was these kind of Archegos scandal losses in the context of a failed hedge fund to the extent of 10 billion. Greensill, you may know that, also enormous losses. These triggered then finally the personnel change. That the long-lasting chairman resigned earlier, not under that impression of these enormous losses, but because his term expired in 2021. But then the new crew on the chairman Axel Lehman tried to fix the problems, but it was just too late. So, also the new CEO was not able anymore to actually change fundamentally the situation. You see here, you can have a look maybe after you get definitely the presentation. That's why I just wanted to give you the impression, a lot of things happened on the personnel side, a not very convincing business model, kind of announcements of strategic shifts which didn't really convince. You had compliance issues. You had kind of risk management issues. So that was a combination of all the kinds of mismanagement, I would call it. And at the end of that process, the bulk of the customers lost confidence and run away. And that process started in October 2022 with this enormous bank run there. The bank run in 2022, one word on that, was triggered by a Australian journalist, which via the social media distributed information. Credit Suisse is actually about to fail, about to go bankrupt. And obviously, these created an enormous uncertainty in the market and started the bank run. And the uncertainty was actually promulgated additionally by an uncertainty on the strategy, because the bank announced already in August, 3 months before, that they will announce on the strategic shift on the 27th of October, but they didn't get the time to actually work on the strategy anymore because they were overrun by the facts or by incidents, and these kind of trigger was executed, quote unquote, executed by these social media driven run in the beginning of October. So this was you know, kind of a first new type of a run. I'm sure, you know, the whole world will deal with that, will try to find solutions then in the next months and years. And this is kind of a really threatening development. You can actually distribute via social media something, and in case the bank is already weak, this is then kind of really you know, how shall I say, catalyze the process and widening the fire, and that's really kind of threatening, because you can, as you know, just press the button and transfer your deposits and your assets to another bank, which obviously makes it very difficult to find a defense strategy against that. And we all know the major problem is short-term funding versus long-term investments, and that's really kind of something that goes a little bit to the heart of the bank model, and also the role of the central banks is kind of really challenging here. But we may discuss. Hopefully, we can discuss that, Rosa, then maybe at the end of the presentation.
Yes.
Okay, let's go to the next page. So I mean, it's roughly 2 months ago since the event. That's not a lot of time. And obviously, what is necessary here is to carefully analyze what happened, what the root cause was, before you can jump into the conclusions. So I call that really tentative conclusions. And I mean, this is really what, as I said, or as I mentioned it, old-fashioned principles. And why do I call that old-fashioned principles? Because the bank business as such is what I normally call is archaic, in the sense that that in that business the trust is the fundament of any business relationship. So you may say, okay, trust is also important for other businesses, right? But the trust has not the same quality if you buy a car, or if you buy a product, or even in an insurance company. You know, obviously the solvency is important of this company, but once you have your insurance policy, hold that in your hand, then you can actually count on this and do not have to be worried about the trustworthiness of that institution anymore. In the case of the banks, it's different. You always you actually go into, or you know, start a relationship first of all about your money, and money is something that you may have earned over a longer period of time, your savings, your investments, and you know, this is kind of the result of hard work normally, or I hope with most of the people this is the case. And so it's kind of really important that you can trust your vis-a-vis. And as we all know, trust is something that is fluid, so it's going to be earned over a long period of time. It's lost. It can be lost overnight. We know that also in our private life, it's kind of a similar, can be similar. So what also is a kind of a consequence of the Credit Suisse case is that we clearly have to think about cultural aspects of leading a bank scrupulously. And obviously, as you say in the Anglo-Saxon world, the fish smells from the head, meaning that if the chairman and the board and the senior management does not fulfill, kind of really high requirements in terms of a corporate culture and ethical standards, this is kind of really in combination with the trust as fundament of the bank. This leads to that development I try to disclose with these kind of slide I showed you beforehand. And the most important thing going forward will be also for FINMA and also maybe for the legislator to introduce tools, and I know this is not easy, that it reinforces again these kind of values when it comes to the selection and approval of the key risk takers in a bank in general, but foremostly also when it comes to large banking groups. Then I said something about traditional Swiss virtues and values. You may believe in that or not. I leave it up to you. But Switzerland 30, 40 years ago had different kind of values that were important, and that made us also successful. So we have to think about that reinforcement and to give these values again a higher attention and priority. About the new type of bank run, I already talked about. And then we will come to that in a second. So there was obviously, especially also in Switzerland, the clear, kind of a clear discussion and the requirement on additional capital and liquidity requirements. This is something that was equally the case in the 2008 crisis. The international community doubled then more or less the capital requirements. Liquidity was a little bit different, but foremostly it was discussed alongside the capital requirements. We may then discuss what is the right number. Maybe we can quickly go to the last slide of this presentation. I just quickly want to show you something. Here you see a chart of the development of the capital, the regulatory capital of banks in Switzerland. This is a statistic by the Swiss National Bank. The Swiss National Bank was founded in 1906, so they have still, the numbers available. And you see here, we started, and this is kind of non-risk weighted capital requirement. So the start was slightly above 20%. So let's say 2022, 2023, then there was a clear decrease. And then you see a kind of a hockey stick then in the 30s. In the 30s, there was already a bank crisis in Switzerland. So same reflects the capital requirements have been increased again. And then since then, there was a constant decrease until 2006. And you see these kind of cliff. In 1996, this was when Basel II was introduced. And then we ended up roughly at the level of 3%, 2.5% capital compared with the balance sheet. So in the meantime, it came up again to 5%. But it's far below what we historically had. So there is a kind of a justification in the debate to increase the capital again. We will see how it evolves. I just wanted to make you a little bit familiar with at least the developments in Switzerland, but I assume that you could show a similar development in other countries. I would assume also in the UK. Based on that, some additional or initial thoughts on prudential conclusions. First of all, and this is kind of a rush in Switzerland politically, everybody talks about additional capital requirements, additional liquidity requirements, and so on and so forth. The merger, just that you know, the merger has not been completed. So the announcement is that they will formally complete the merger in the course of June. However, the merger will be executed on the top holding companies. In other words, the UBS holding company will absorb the Credit Suisse holding company, and underneath, especially when it comes to the parent banks, which hold, or in both cases, hold the banking participations, nothing will happen so far. So we will kind of have to live with a limbo that could last several months or even more than a year or so. And we just don't know so far how the merged bank will look like. So we see or we may see in the meantime, and already see it, the escape of employees, the escape of customers, and that will lead to in my conviction, to a totally different merged bank. So this is number one. Number two is, and that's a typical Swiss situation, the United Swiss Bank will still be big, but most likely not so big as in the political arena, especially the discussion is ongoing here. So I assumed it will not be bigger than 1.5 times the Swiss gross domestic project, Swiss gross, or no, not gross, domestically product per year, which is actually 700 billion. The gross domestic product. I'm sorry for that. And the new bank will most likely be not bigger than 1 billion or 1.2 billion. So on that end, it will not be riskier than it was before. And then obviously what we also learned from the crisis is also in the US, that the business mix is important. So it will mostly be wealth management. So this is, at least the assumption is, it's less risky than the lending business. However, lending and borrowing, however, we have seen, or also experience has shown us, that this is maybe not true anymore. So with the press the button possibility, you can also move the liquidity in the wake of the wealth management and the assets as such relatively quickly. Anyway, we hear about requirements of between 20 to 30% CET1, which would be 4 to 6 times higher than today, which is totally unrealistic, given the standard we have in Basel and also in the major financial sector. So this would really be a disaster for a UBS and would lead to the leave of UBS from Switzerland to somewhere else, let's say maybe to London, most likely to London from my perspective. So if such kind of requirements would become a reality, then we will lose UBS in Switzerland. That's for me absolutely clear. So here we have to be a little bit careful. And then liquidity, and this is really a major issue I already touched upon. We have seen in the crisis that liquidity scenarios are by far too benign. So you know the underlying liquidity stress of the LCR, which really I think needs to be revised. So in combination also with these kind of new type of bank runs, with these problem we have on the funding side, so kind of transformation from the short term to the funding to the longer term assets. There are, from my perspective, enormous challenges ahead of us. And you may have also read the article of Mervyn King in the Financial Times about that topic. Not that I really share the solution. You know, what I liked is that he really described the problem properly. The solution he offered is maybe not the end of the story, but at least it should be come transparent, and it should also be debated in regulators and central bank circles, that it's really kind of a thing that should be urgently tackled. Okay, then next page, please. And this is about tentative conclusions in the resolution area. First of all, if the world develops concept in that area, which has been the case over years, then there is no excuse by way of, yeah, it would have worked, but in this crisis not. So this is what the head of the FINMA told the public at the evening of the 19th. And this is really not the way it should work. So the aspiration must be clearly, it should work in every possible case. That's number one, and that's a really high, a high standard. Number two is the kind of in-depth analysis I already talked about. And here, I think the option one of a resolution, the restructuring and the continuation of the bank operations in a going concern in a slightly or in a different manner with a different business model could work and is also prepared in Europe, in UK, in the United States. However, if it doesn't work, it really must be the case that the orderly wind down gets a fair chance. If we come to the conclusion that this isn't possible to trigger the orderly wind down or the bankruptcy, to use a hard term, then I seriously question whether the too big to fail regime really works. So this is really a challenge, because also in this kind of Credit Suisse rescue operation, as you know, there was a huge pressure from the US especially, but I assume also from the UK, not to trigger the resolution. So they really were happy, as I said in the beginning, with this kind of merger solution. But as we all know, the proof of the pudding is the eating, and the eating wasn't the case here. So we just don't know whether these kind of too big to fail concepts really work. And one has to find ways to either make it work, testing it, and so on and so forth, and to apply it in a real case. If that is kind of not possible, or there will also be reluctance, and Mr. Biden tells the community again, we will guarantee all the deposits in order to avoid anything here, then we have to find other ways. from my perspective. Then we have some structural problems you may be familiar with. We don't have an international bankruptcy law. We don't have a states treaty that that makes it possible to acknowledge decrees taken by the local authorities. And I'm just talking about the cross-border context now, and accepted or acknowledged by host country jurisdictions. So these are the two structural issues we know since years, but they didn't solve it. Just a little bit a side remark. There is a global bankruptcy law, model law existing established by the ANSI rule. But there is an exception for the financial institutions, and maybe one should at someday try to make an effort again to bring that on the table. I tried it when Switzerland has held the ANSI chairmanship in 2014. Unfortunately, there was a lot of resistance by the US, and so this was buried at that time. But it's almost 10 years ago. And maybe it would be worth to rejuvenate that again. About the orderly liquidation I talked about already, there are also deficiencies in Switzerland. The concept doesn't work. I don't want to go into the details right now. What I would like to emphasize here is maybe we have to find a third way between restructuring in a going concern and the kind of relatively harsh and risky way of orderly wind down or bankruptcy. And we should maybe think about a runoff in a way. I intentionally did not want to call it a solvent wind down, but we know the runoff from the insurance industry, and it could be a way to think, you know, to allow the bank not to sliver into the bankruptcy gone concern, but also to stay going concern, but with a changed purpose of the bank, which forbids new business. So you really kind of wind it down in a going concern, and the purpose is to wind it down and not to make new business. So this is a kind of middle ground between the restructuring going concern and the bankruptcy gone concern. Okay, do we have a next slide? I think it was the last slide. I thanks a lot for your attention. And if there is, I understand that there is not a lot of motivation to discuss or to ask questions, but I'm obviously available to start a discussion on topics raised by you or to answer your questions.
Thank you, Reto. This really was a wonderful presentation, which shows, you mentioned at different stages throughout the presentation how the credibility of the regime that we have established, in this case at the national level, but you also talk about some international principles and the new philosophy. And really, after the global financial crisis, many jurisdictions, certainly in the EU, in the euro area, we adopted resolution tools and bail-in mechanisms to avoid a repeat of taxpayer fund bank bailouts and the altering of the existing creditor hierarchy, putting shareholders ahead of bondholders of ATI1 bonds really has sent some tremors through the bond markets. So we have here a question, we have a raised hand, but we have a question in the chat, which I will read to you by Pierluigi Barbarazzi, asking about the Credit Suisse bondholders, which took legal action after the 17 billion wipeout of the bank's 81 bonds. And he also says if you can comment on that, as well as the FT reporting that Credit Suisse staff are going to sue FINMA, the regulator, over the lost 81 bonuses.
Yeah. I did not go into that minefield. intentionally, but I'm happy to give you a response to that question. I think it's highly, that's my personal conviction, it's highly questionable whether the measure taken by FINMA to write off the AT1s was justified. So I have understanding for everyone who brings that action to court. As you may know or have read in the newspapers, there were more than 2,000 claimants that submitted a claim before the Swiss administrative court, which is responsible for that matter. Especially, it was mentioned by the one who asked the question, the Credit Suisse staff. And here we talk about a special instrument which is called the Contingent Capital Award. Contingent Capital Award was created for the top managers, and the idea behind is that they should actually also suffer losses in case needed, because they're ultimately responsible maybe for the mess. So you may say, okay, from an ethical point of view, it's not really very desirable that they challenge now the AT1 write-off. However, they're bondholders as anyone else, so they can obviously submit their claims against they can actually challenge these action taken by FINMA either. I think we do not have the time to go into details of that issue, which is relatively complicated. But what was clear is that there were a number of announcements made by FINMA also, and also by the National Bank, that Credit Suisse was always up and running in terms of capital. And a write-off obviously does not create liquidity, as we know. The bank has basically a liquidity problem. So the question comes up, whether or not a write-off of the AT1s really was kind of effective, or could be, at least also theoretically effective, to improve the situation, which is indeed questionable, and is a major topic vis-a-vis the courts.
Yeah,
I don't know whether I have answered the question.
Yeah, as you say, there are many complicated issues, but you have certainly given a very good answer to what is definitely a challenging legal issue. We have a question by Martin Harty. Martin, you want to ask it yourself? You have raised a hand.
Yes, please, if I may. Your last slide raised an issue which I thought arose very early in your presentation, which is, at what point is a financial institution too big to save? And how would one go about assessing that? I mean, would you look at it in terms of the ratio of the government or central bank exposure to GDP, or what? Obviously, in the States, JP Morgan may actually be too big to fail and too big to save. That might or might not be the case of UBS. The second question,
that's a good question. And maybe
may I ask a second question? Forgive me for interrupting you.
No.
The other one is, it's related, and there comes a point when the business risk of an institution which is arguably too big to fail and or too big to save is almost too important just to be left to the bank itself. Now, when it comes to investment banking, we all know that there are any number of ways to lose vast sums there. Retail banking isn't necessarily safe. Let's take two examples. HSBC got into terrible trouble in Mexico as a result of money laundering issues. And in Britain, the banks managed to lose monstrous amounts of money over mis-selling mortgage insurance protection. Wealth management throws up its own issues in terms of money laundering, tax evasion, and anti-bribery. So there's no risk-free area in
Yeah.
this. And to the extent that the exposures within an institution which is or is not too big to fail or save actually do raise issues on national economic security. I wonder if you had any observations on that. I'm sorry for putting two questions together.
No, this is absolutely legitimate. Let me try to answer your first question, and for this, can we quickly go back to the presentation, because there is a slide, the second last slide.
That's it. Yes,
Okay. I mean, if not, if it's this, maybe this is too time consuming. I can comment quickly. So the question is too big to save, and obviously, we know. I just draw the line to the United States. You have in the United States, you have a number of really large banks. The largest in the world is JP Morgan. You have equally big, or not a lot less, is Bank of America, a Citi. You have then also Morgan Stanley, you have Goldman Sachs. These are more wealth manager or investment banks, nevertheless. So you can ask, are these banks too big to save for the United States? The answer is no, because the United States, the stake they have in the US is given the huge size of this economy is still relatively low compared to the GDP. So that was also a part of your question, is what is the yardstick? What are, against what can you measure the too big to save? And I have to confess, that I don't know any other yardstick than to measure these against the gross domestic product. But maybe there are other measures to be taken into account going forward. But so far, this was the yardstick. And when you actually look at Switzerland, things are different. We cannot, we talk about, even if you combine in the US, all those balance sheets of the really large banks, they hold in total not more than 20% of the US GDP. I just didn't calculate it, but it's on the top of my head, this is not more than that. Maybe it's 25, but it's not kind of the US economy could not digest, as opposed to the UK. In the UK, things are different. And it's a little bit more threatening there, and questionable whether these are really too big to save or not. And you remember in 2008, and I listed them, this kind of nationalization. This is an enormous risk for the UK, and HSBC is a special case because they are not really a UK bank. I think they are more than maybe a Hong Kong bank than a UK bank, but the official domicile is in the UK. They're supervised by the UK. So ask yourself whether the UK economy could afford to nationalize HSBC if needed. So this is questionable. And in Switzerland, it's also questionable. And this leads to the conclusion, maybe they're too big to save. And the debate is ongoing in Switzerland whether UBS combined is too big to save for our country. And the recipes are relatively open, but obviously you can actually put on them capital requirements of 20 to 30%, liquidity requirements, all other kind of thing. And then they are not competitive anymore. So maybe the worldwide community comes to the conclusion that the too big to save banks have to be splitted off, and obviously these kind of movements should really come from the US. I always remember the Standard Oil case in 1890, where Standard Oil was so dominant that they decided to split it off in different smaller pockets, so to speak. Maybe this is a debate that is triggered again or starts from scratch now? We will see. But the topic is absolutely on top of the priority list from my perspective. Definitely for Switzerland, maybe also for the UK. And that's my answer to that. Number two, the business mix. Absolutely in agreement with you. I'm coming from a country where the wealth management is very dominant, and everybody told me, look, don't care about these too big to fail issues or financial stability issues, and wealth management, that's not an issue. The opposite is true. The opposite is true. You have enormous a lot of conduct risks. You listed them, Martin, and you have the new type of bank run situation. All these rich clients hold, a chunk of their assets in liquidity. Depending on the development of the interest rate, it's more or less. In the past, it was a lot. And, they can actually move around all those issues, all those liquidities or these deposits, as well as the assets under management by way of a click. And this creates these kind of run situations, not only in the deposits area, but also when it comes to the assets under management. So in the wealth management area, you are actually facing the same challenges. Retail banking is highly exposed as far as bank runs are concerned. So, and you alluded to conduct issues. Conduct issues can be very severe, especially also for groups like HSBC with a huge presence in different countries that are risky. You mentioned Mexico. I could mention Banque Nationale de Paris paid a 10 billion, as you may remember, a 10 billion fine in 2014 for the infringement of sanctions taken by the US against Iran, against Cuba. So you're facing in the large cross-border groups enormous a lot of conduct as well as prudential risk. So what is the conclusion? The conclusion is really, believe it or not, I think there should be a debate launched about the size of those large banks on the backdrop of the digestibility of these kind of risks by the national authorities, by the taxpayers, and so on and so forth. If not, I can assure you the next crisis will be more severe than the one we had. I don't know, Martin, whether I have answered your questions, but
you've answered them very well and very effectively. And if there isn't another question, I've got a third question for you, but Professor Lastra may have other people queuing up to ask questions.
No, you can ask your third question, and then after that, I think we will conclude.
Thank you very much. Your suggestion about international bankruptcy conventions or arrangements, the problem is that most financial transactions in the investment banking area are written under either English law or New York law. And there's an expertise that's developed in New York, the consistory courts of Delaware, and the Commercial and Chancery Division in London, which enables them to deal with some of these issues in a way that is almost certainly more effective than any other courts, because they have the experience, they've got the infrastructure of lawyers and accountants, and they do it fast and very transparently. It's a polite fiction that all the courts of every country of the world are equally good at dealing with every sorts of issue, but that isn't actually true. And one of the problems is that America will never yield jurisdiction on anything unless it can see an immediate advantage and can persuade both Congress to pass it. And secondly, just as a practical matter, could you really imagine the Lehman administration of the European subsidiaries to have been handled anywhere else other than London?
I totally share with you. I know obviously all those places you mentioned, be it London, be it the US, be it New York. I mean, that's where the capital market is. That's where the huge transactions are concluded. No doubt about that. I think in the area of the derivatives capital markets, UK law and New York law plays the dominant role, and I'm not so much scared about that. I'm not so much scared about that. We have there the experts, as you alluded to. So these could be effectively tackled. The problem is more the procedural. I mean, if it comes to the bankruptcy decision will be taken by the home authority. So in the case of Credit Suisse, would have been taken by FINMA. And what happens then is that FINMA is responsible then for the branches, with some exceptions. For instance, the New York branch will not be on the Swiss law. It will be on the New York law, because the New York state knows a branch bankruptcy law. But let's say the London branch, I assume that the UK will accept the competence of Switzerland. However, for all the subsidiaries will follow the local bankruptcy law. And also the local authorities will be responsible, which is an enormous obstacles, because if you decide something in Switzerland, it's not necessarily being acknowledged by the UK or by the US or by Germany or whatever. So it takes a lot of time to actually implement all those decisions. You know, in some countries, you only have to reach out to the administrative authorities. In other countries, you have to challenge any decision before court. Takes time, and so on and so forth. So from a procedural point of view, this is an enormous kind of potential obstacle to actually to run efficiently a cross-border bankruptcy. And that's just a practical problem. So that's why everybody is, this is one of the reasons I'm convinced that everybody is so reluctant to implement the orderly wind down by way of a bankruptcy, because everybody is scared that these kind of system of different authorities is not effective.
Thank you very much indeed.
Thank you very much, Martin, for those 3 questions. Thank you very much, Reto. I mean, you have really raised a very significant number of issues which really need further debate. And I hope we can find another occasion to continue to debate it. I mean, I'm particularly intrigued and share with you the concerns about size, particularly in relation to the national economy, and with the exception of the US and perhaps China, but in terms of world capital markets, the US, of course, remains far more relevant. The other countries, when we talk about the too big to fail, a lot of the efforts post GFC that we have done have addressed the TF part of the TBTF, but the too big, remains really unaddressed. And all competition or antitrust law in the US, you mentioned Standard & Oil, also the AT&T, is a reminder that avoiding undue concentration of economic or financial power is necessary for the efficiency of capital markets. And also that's something that we may need to look further. And like you, and we're doing now this work together in UNITRA. Yeah. I think UNCITRAL take back this work that you were saying, and notwithstanding definitely the importance that London and New York still hold on capital markets transactions, and as well as all the bonds which are governed by New York law and in English law. Still we need, because of the reasons that you mentioned with banking and financial groups having subsidiaries in different jurisdictions, we need to have further harmonization of the principles that govern these transactions. So with those 2 thoughts, there are many others that we haven't had really time to talk about. including the fundamental role of emergency liquidity assistance, always the first line of defense in any crisis, and then the limitations that also may have. I think we will conclude. I will read to you what one of my former students, who is now the senior partner for Baker & McKenzie of Latin America Banking and Finance, writes in the chat. Many thanks, Dr. Reto and myself, for such a good session. Happy to see that after more than 30 years, the Center for Commercial Law Studies keeps on leading the discussion in this space with a unique quality offer of academic regulators and professionals in the field. And of course, it's thanks to you that we have had today such an enriching session. So thank you very much, Reto, and thank you very much, everyone.
Thanks, Rosa, and thanks to everyone. It was a pleasure.